Hey, welcome everybody. It's Hammer coming to you this week, February 22nd, 2023, with another mortgage market update, keeping you guys all up to speed with what's going on with interest rates, the mortgage rate market. This week, I have an awesome guest with me. I have Randy Teakell here. Randy, please take a minute and tell everybody a little bit about yourself.
I am a Texas broker, been lending since June of 1989, been a part of the vetted VA since we started. Just love and honored to help veterans and educate them in every way, shape, or form. And that's what I enjoy to do. So
Awesome. Well, thank you for joining us today. Appreciate having you here. And for those of you that are here live, do us a favor, say hello. Let us know in the comments who you are, whether you're a mortgage professional, a real estate professional, or a consumer. And let us know if you have any questions. Please, by all means, make sure that you ask us anything you want to talk about today as far as mortgage markets, the housing market, rates, pricing. If you want a good chicken cacciatore recipe, whatever you want, we got that ready for you. Actually, you cook, don't you, Randy, or do you barbecue?
I have a wife who's a really, really great cook.
The wife is a great cook. All right. So,
yeah.
But if you're watching on the replay, do us a favor, give us a hashtag replay. Let us know that you were here. I know that many of you can't make it live, but you guys do watch each week and see kind of where things are at. So basically, let's start with a quick recap. What we said last week was that mortgage rates are moving higher. And a quick recap of actually what happened last week. Let me bounce through some slides and we'll get to that. So rates are continuing to move higher last week in anticipation of more Fed rate hikes. I've showed you guys this chart before. I'm going to show it to you again. So basically, we've talked about how mortgage rates are reacting now to the interest rate hikes that are expected to come from the Fed in March and at their May meeting and at their June meeting. So later in the year, the Fed is anticipated to raise interest rates. And we'll spend a little more time on this in a minute. But we're seeing those reactions actually happen now. So mortgage rates have been going up significantly the last couple of weeks. We've seen a full 180-degree swing in the momentum. Before, when it was actually Groundhog Day, February 2nd, was some of the best mortgage rates we'd seen in months. And it looked like we had clear sailing. Things were going very well. And then what happened is a couple of days later, we had some jobs data. We had 517,000 new jobs created. And that is a huge, huge number. It was almost 3 times what was expected. And what that did is it kind of sent things off the rails because it told investors that the economy is resilient and it's not going to slow down despite all these Fed rate hikes. And the Fed has been hiking rates to fight inflation, as we've talked about in the past. And because the Fed is expected to continue to hike rates to fight inflation, we're seeing mortgage rates move higher now. And that puts VA rates in the low to mid sixes. Randy, is that what you're seeing for your clients generally, is low to mid sixes on VA loans right now? Am I off the mark on that?
Okay. Yeah, absolutely. We locked we were fortunate to lock quite a few loans in the fives, even the low fives for before the jobs data came out. And then and unfortunately after that, it's definitely changed up, whether we're locking stuff in the low sixes and even some mid sixes, depending on the FICO scores.
Yeah. So, and then conventional rates, if for any reason you're not using a VA benefit and you or someone you know is going with a conventional mortgage, meaning just a more mainstream loan that anybody can qualify for generally, that is your higher sixes, maybe even in the sevens. If you get a rate in the sevens, they're not necessarily taking advantage of you, especially depending on credit score, the amount of money that you're putting down on a primary residence. And then if it was a second home, then it would be much, much higher even, or an investment property. So for those of you that are just trying to get an idea, what are rates really at compared to what you might be seeing in the ads? These are kind of where you'll see. Randy, does that sound about right? You see something very similar to that?
Yeah, exactly. The biggest thing is, they're varying day by day. I mean, today's numbers are looking like they could have some positive, where that maybe they have the dead cat bounce, they call it, come into play, etc. But yeah, we're still in that same range.
Well, let's talk about that. Let's go ahead and go into kind of the rate forecast from here. In my opinion, for me, I think rates are going to continue to move higher from here. And the reason that I believe we're going to see rates move higher is that markets are currently pricing in even more of an aggressive stance by the Fed. So just to kind of clarify for everybody one more time how it works, the Fed only controls one rate, the Fed funds rate. That's the only rate they directly control. But that rate is the underlying kind of grandfather rate for everything: car loans, consumer debt like credit card debt, for title loans, for almost any other kind of loan out there. Now, the Fed does not control mortgage rates, but they affect mortgage rates. And the way that they do that is when they're anticipating to be raising rates at their future meetings to slow down inflation. And the reason they raise rates is to slow down the flow of money. And when there's less demand, that allows supply to build up, and that'll bring inflation down. And this anticipation of all these Fed moves to come in 2023, more at the time. Traders are actually reacting to that now. Because of that, we think that we're going to continue to see rates move up. And I'll show this chart real quick, and we'll kind of go over. This is the Fed futures chart. So when we look in March, we're expecting to see that the Fed is going to raise rates by a minimum of 0.25%. But there's actually some of the members out there, like St. Louis Fed President James Bullard here, and him and Cleveland Fed President Mester. They both believe that rates should be raised in a more aggressive manner right now. So right now, the Fed raising rates 0.25% at each of their meetings. They raised at the last meeting, and they plan on raising at the March meeting. But these members say, hey, we need to see more aggressive rate increases, really to stamp down inflation. Inflation's not getting better fast enough. And the markets are concerned about this. Now, the St. Louis Fed President Bullard is not a voting member, so he does not get to vote to see rates go up. But today at 2 p.m., we're going to get an idea of if any of the other Fed members that do vote, how they feel, because we're going to get the minutes from the last Fed meeting from last month. Those are going to be made public today. We're going to be able to go through them and see, are there other Fed members, even though they all voted unanimously to only raise rates by 0.25% back at the February meeting, is there anybody that said, hey, we may have to be more aggressive? And if we do see that today in those meeting minutes, we could actually see mortgage rates get a little bit worse later in the day. As we've talked about, mortgage rates can actually change anytime. They're not just once a day. So we could actually see that happen. But overall, that overall idea is rates are likely to continue to move up from here. I don't think we're done seeing them move up yet. I think we're going to see rates kind of match the highest levels we saw back in last October. So October of 2022, we saw, VA rates hit into the high sixes, conventional rates were in the mid sevens, and I think we're headed that way. What about you, Randy? What do you think?
So what I wanted you to do, Helmer, was explain to us about how the Fed and who they are and how often they meet and how that trickles down.
Okay, great. Thank you. That's a great question. So if the Fed is, of course, our central bank, they generally meet approximately every 6 weeks. So we're going to have a Fed meeting on March 22nd. We had a Fed meeting at the end of January and February 1st. And the meetings are actually 2 days. The second day, when they end the meeting, they come out with what they call their Fed policy statement. And they say, okay, this is what we think is happening with the economy. If they're going to hike their Fed rate or reduce their Fed rate, they do it at that statement, at that time. So at the last meeting on February 1st, they raised it by 0.25%. The next meeting is March 22nd. They're expected to raise it 0.25% then. The meeting after that is May 3rd. Then we've got a meeting June 14th, July 26th, again, about every 6 weeks. And the expectation is that we're going to see these gradual rate hikes at each of these upcoming meetings, because it takes a long time for the Fed activity of raising that Fed rate in order for the rest of the economy to start to slow down. And they call that a lag. So they want to be careful, because if they raise rates too aggressively and they hit the brakes too hard, they slow the economy down too much and we go into a recession. And that's what they don't want to do. They're trying to get what they call a soft landing. They want to see that the employment market, that the labor market stays strong, that unemployment stays low, but they want to see inflation get back down to around their 2% target. Right now, inflation is around 7%. So that's what they're trying to do, is see it push down into that. They'll do that by raising that Fed rate, which, like I said, will slow down the rest of the economy. And that's what everybody's reacting to.
So one of the big things that for me that I see have playing out recently is it's kind of like a game of chicken. I don't know if you ever played that when you were a kid, but two kids on a bicycle going straight for each other. Who's gonna go? And if you don't, then you both crash or whatever. And that's kind of what I've seen the market doing. as far as the market and the Fed is the market is basically, over these last few months said that they don't believe that the Fed is going to keep on the straight path, et cetera, that they believe they're going to come off. Maybe some of that's data driven, maybe some of it's not. But what seems to me like what happened was that Friday that you mentioned, Good Friday or whatever, that from that point forward, all of a sudden, I think the market has decided that they believe the Fed. Would you say that's accurate?
Yeah, very accurate. And that's a great observation. And that's exactly what happened is that the Fed members, including Fed Chair Jerome Powell, who heads the Fed, they were saying that they felt that they were going to need to raise rates the next couple of meetings, being at least two, and that they would need to raise rates to above 5%. And the markets have been pricing in up until 2 weeks ago, or now coming up on 3 weeks ago. The market had been pricing in a 4.75 terminal rate, meaning that's as high as the Fed would go, and that they would pause their rate hikes and let the economy settle. And then we would see rates actually start to come down again as they try to restart the economy. What's happening now is that markets believe the Fed members that they're going to have to raise rates. And what's changed is other economic data. There were signs that we were seeing a slowdown in the economy. We were seeing certain other data besides inflation that showed things were in a contraction state. There were other indicators, and those indicators right now not showing that. Instead, we're seeing very resilient spending. Consumer spending is what drives our economy. And you've got full airplanes, and you've got full movie theaters, and you've got full everything. People are out there spending money, and that's keeping that concern that the economy is not slowing down enough, and that the Fed will be more aggressive. And that's what we're seeing the reaction to. I'm going to go ahead and show a quick chart, and along with what you were just talking about, Randy. So this is a line chart to make it a little bit easier for everybody to kind of see. And what we're monitoring are what are called mortgage-backed securities. These are the bonds that are sold on the back end. We've talked about this before. This is where your mortgage pricing starts. This is your base layer. And then what happens is every lender adds a little bit on top of it, depending on how much money they need to run a profit and run the company and cover costs and staff and everything else. So, but generally, when these lines move up and down, all mortgage rates across the board are going to move up and down, even though you always want to shop around on different lenders to see what their rate may be to you, the consumer. It's going to go up and down as a whole based on this. Now, when these lines go lower, that means mortgage rates go higher. And when we see these lines go higher, that means mortgage rates go lower or improve. So back in October, you could see we have our lowest points over here. And let me turn this banner off so that we get rid of that. There we go. So right down here, you could see in the middle of October, that was the low point. We saw this line drop all the way down. And this is also going to correspond to when we saw the highest mortgage rates. And then as we were moving away from October, and we saw signs of inflation starting to slow down, we saw mortgage rates improve. And you could see this line has traveled up higher. And then you could see recently, though, and again, here it is right at the beginning of February 2nd, that was one of our highest points. And that was our best mortgage rates recently. And then we've seen since then, it kind of drops down. And you called it a dead cat bounce, Randy. And that's very accurate. They're almost like ski jumps, because you'll see a line down and then it jumps and you can fly off. Then you'll see another one. And when they've had enough, they just a little bit, just that little uptick where you would be able to fly off. And we see that each time. So we're seeing that right now, which makes it a good time to lock in an interest rate if you are in a position that you need to lock. We're very likely to see another line down continue from here in the next couple of days heading into March. We'll see those continue to go. Anything that you want to add about this?
No, I think this is a great observation, just to be able to see that. It's difficult for people to watch the market and not understand that there's a couple of layers of things involved. And one of the biggest things for me is that the market folks, the Fed, if you will, seems to make their decisions through the rearview mirror. And so some of the stuff seems to be a little bit slow getting to us. And then and the MBS folks, the market themselves are looking at real time and in the future guessing what the Fed is going to do. Yeah. And so it makes it a little bit very, very difficult, no crystal ball to see what's happening, et cetera. And I guess my question to you is up until just recently, up until February, whatever, there was a lot of folks that were experts like yourself that were saying that that we were going to expect better rates in the next year or two, and obviously a year or two gives a lot of leeway. But what is your thoughts on that part of everything? Obviously, doesn't tell us where we're going to be tomorrow, but just the general feel.
Right. And that's why when people say, Hammer, you said that things should actually improve and now they're getting worse. What went wrong? What didn't you see? And it is, Randy, it's like forecasting the weather. We have certain conditions, and based on those conditions, we can say, okay, this is what the temperature is going to be. This is what the rain's going to look like. But we never know if there's a fluke storm or if the weather starts to change, and then we have to re-report. And that's exactly what happened, is that the last few months we've been in this range here. And you could see, if I were to draw a line, I'm going to use this here, and I'm going to draw some lines. I want everybody to think of this as a range. So this is the bottom, this big line, and this is the top right here. And you could see that we've kind of been in that range, and we touched down, but we bounced back up. And as long as we were in that range, it looked like we were going to see rates improve over time. And what would have driven that is a slowdown in the economy. And even a recession, as we go into an actual recession and the labor market gets a little bit weaker, meaning people get laid off and wages come down or wages, stagnate, that's actually very good for the mortgage market. I know it's not good for the overall economy. You certainly don't want to see your neighbor lose their job, but it is very good for mortgage rates. And that actually helps the mortgage market. But what happened is that all of those reports that were saying, hey, it looks like the economy is slowing down. I could ramble off all the jargon to you guys. PMI reports and PMI, ISM manufacturing, ISM non-manufacturing, and the different wholesale and consumer inflation data, all of these different reports on that. Well, now we're seeing signs that people are spending money, retail sales, consumer spending, consumer confidence, that people are spending money. The economy is not slowing down. The labor market very, very strong. And that's what created that turnaround. And when we saw that turnaround, now you can see we've broken through this floor and we're back down here. And we're very likely heading, just like we saw here in October. When, again, before that in September, we were very high, and you could see that there was a big drop. And this went, if I were to draw a straight line, this went right down here. We're going to see something similar over here. And the reason we're seeing that is because, like you said, the markets before were kind of know-it-all. They said, hey, we know better than the Fed. The Fed says they're going to raise rates, but we've seen all these reports. The Fed's not going to be able to raise rates, Randy. They're going to have to slow down because all these reports are showing inflation's getting better, the economy's slowing down. They're going to have to. We're not worried about it. And then those reports started to change, and everyone went, uh-oh. Maybe the Fed really is going to raise rates. Maybe they are going to be more aggressive. And then now these reports are actually showing stronger labor markets. And, even though we saw inflation get a little bit better last week, it wasn't enough for markets to be happy. They were like, yeah, it was just a little better. It wasn't a lot better. And that's kind of what's changed. So as far as what we think will happen, eventually we will see the economy slow down as the Fed continues. It's kind of like if I wanted to drop this Sharpie marker, and I lift it higher and higher, and I say, okay, maybe dropping it from here will work. And I go, nope, I'm going to lift it higher. Eventually, they're going to drop it. And when it drops, it'll fall, and we will hit a recession, and mortgage rates will improve a little bit. But how much higher will we get till we get there? Now it looks, the phrase that I've been using over and over is what seemed unthinkable just 3 weeks ago, going to rates in the 7s, now seems unavoidable. So what was unthinkable now seems unavoidable. And it isn't that I've changed my mind. It's that we're interpreting all of what we see. We're kind of watching the tea leaves. And that's what's changed is the economy, the traders, markets, stocks have been down tremendously the last week. Some of the worst numbers they've seen in quite a while. All of that driven by that same thing.
Right.
So what do you think? Do you think rates, the question everyone always says is, our rate's going to come down, and I know that there's some mortgage professionals like yourself, Randy, that they're frustrated because they're saying to their consumer, we need to lock in a rate. And as a consumer right now, you have FOMO, fear of missing out. Nobody wants to take a rate at 6.25 when you saw 5.75 just a month ago. When you say, I think it's going to come back down. What would you say, Randy, to someone that says, I think rates are going to come back down, I want to wait?
Well, my biggest thing, and I've had a couple of those discussions, is just that the beauty of a rate lock is that if things dramatically improve, most lenders are willing to renegotiate the rate. That is a huge thing for me is, you know, if you're a gambler, and that's really what it boils down to, if you're a gambler that things are going to get better, then you're not harmed by locking your rate. You're not going to lose anything, but you're going to be able to sleep and know that you've got something in your hand. The renegotiation is a huge thing if rates got dramatically better. If the Fed came out and said we're not going to do, you know, the things that are going to lead to higher rates, and we're going to change that trend, etc. In the worst case, with me on the broker side, I could always switch to a different lender as well. That, you know, if I had the loan locked. And so my biggest thing is to talk a couple of people in that were saying no, they're going to get better, because in what it's absolutely has happened is have people that were shopping at 5.25 on a pre-qual, and then they get closer and it ends up being 5.625 for the rate that when the contract's actually in, because you can't lock until you have a property.
So you find a property, right?
And even people that you know, maybe 5.25 and then come back 2 months later and they don't understand why the rate's at, you know, 6.25. So it's a very, very personal thing that you have to make up your own risk bias and where you're going. And again, I subscribe to 4 different, you being one, you know, and 2 others that I look at every day. And it's just very difficult to know anything. You get a comfort level, and if you look back at that graph, when you're in that same range for a while, you get a little bit of a comfort level, but then something comes back in, like, you know, this February 2nd, and knocks you out of that comfort level. And at that point in time, you have to step back and say, hey, you know, I feel better about just being locked, because if this thing continues like it did last time, you're in a position that you're at least saved. And if it comes back, then we can always do other things.
What about somebody that hasn't found a house yet and can't lock in? Should somebody stop going out looking for houses right now because rates have gone up? And why wouldn't they want to wait until rates drop?
Well, one of my big things with that is about last October, roughly, the same things that you were talking about. The market for housing itself, at least in Texas, where I am, prior to the 2 prior calendar years, let's say 2020, 2021, it was a crazy seller's market, and people were doing silly things like, you know, you'd have people that go out and offer a $200,000 appraisal waiver, like, the home's listed for $500,000. I'm going to give you $700,000 for it. I'm going to guarantee the $200,000 difference. Stuff like that made it crazy, and so it made it very difficult for the average person to go out in the market and not get frustrated, because there were so many buyers, because of the low rates, because of the lack of inventory, that anything that came on the market was just flooded with offers, and it was a crazy offer market. About October, I started to see it be a lot more balanced. And one of the big things that's happened as a result of this has been that people are able to get seller concessions, which they weren't getting at all before. People have able to actually negotiate the pricing. We've seen price drops in Texas. I think it was numbers like over 20% of the market. The rates were, or the sales prices were actually dropped. And so from the standpoint of being able to negotiate and being able to find what you need, the market is still, the housing market is still limited, low in inventory, but there's not quite as many buyers out there at the higher rates. And so you're going to see the availability to buy a little bit better. Rate's not going to be quite the same, but the pricing on the house may not be the same either. And so the affordability factor may end up being better for you overall. Plus you're able to find the home that you want. Does that make sense?
Yeah. Absolutely. Makes a lot of sense. And it's definitely something to really point out to everybody, is that when there's one downside, being the higher payment with a higher interest rate, there are upsides, meaning, you know, it's a little bit easier to get the homes that you find. But one thing too to point out, are you finding that we're in a housing bubble? Have you seen a lot of inventory hit the market because rates went up?
No, absolutely. We're still low. I mean, the inventory is still low. There's still, there's not as many players, it's not as many buyers as there were before, but there's not a bunch of folks that are just dropping their rates like crazy.
And
or their prices.
More of the people that got a low rate, whether it was buying the home or refinancing to a low rate that we saw during the pandemic and the 2s and the 3s, those people aren't moving. They're sitting on their houses. They've got great payments. They've got great rates. And that's keeping the inventory low because there's not existing homes getting onto the market the way that we're used to. We're not seeing more homes get out there. So that's what we see that nationally. And you're seeing that in your neck of the woods in Texas too?
Absolutely. All over Texas.
Yeah.
Bottom line is people, if you've got a 2.25 rate and your home is maybe a little uncomfortable for you, but then you look out there and you're looking at a 6% rate. If you get a house that's a little bit more comfortable, then that could make a 25-35% difference in your rate. You're more likely to do. I'm getting a lot of people wanting to do like loans to add on to the home, etc. That sort of stuff is coming more.
Absolutely. So, well, quick shout out to another vetted VA professional, Gay. Good morning or good afternoon, depending on where you're at. I'm at afternoon. I know most of the country is still in the morning though. So, thanks for joining us. So, all right. Well, Randy, I think it's been a great, very, very informative call. Thank you so much for joining us today. Is there anything you want to leave everybody with before we wrap up?
Nope. I just really appreciate you guys being here to educate folks, and that's exactly what this vetted VA is all about, is educating people and getting someone besides their trusted loan officer to talk to get a second feel for the market. And I send people to you all the time.
Oh, awesome. Thank you. So remember, everybody, we're here every week. You can join us each week to discuss rates, 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And we're here to answer any questions. If you were here live, make sure you let us know. If you're watching on the replay, make sure you go ahead and give us a hashtag replay. If you do have any questions, go ahead and post them on here. We do monitor the chat. Feel free to tag us. You can click @Helmer and it'll bring up my name in Facebook, and I'll that way I know you've asked a question and I'll answer it. Otherwise, we do keep an eye. Well, Randy, thanks again for joining us, sir. I'm going to go ahead and wrap it up. If you want to, goodbye, everybody.
Giddy up.